Good afternoon and welcome to Managerial Accounting Fall 2022 semester. As I like to do, we'll start with looking at the calendars to remind you of what's coming up, what's due when. So we finished chapter 22 last week. And so the chapter 22 problem should be submitted for grading by the end of the day today. And we'll be starting chapter 23 today and covering that this week. So the chapter 23 pre-quiz should be submitted by the end of the day today as well. On Thursday, then, the chapter 23 exercises will be due. And next week, we'll be shifting to chapter 24. Excuse me. I also have added the 2 remaining review sessions to the calendar. So you'll see those as they come up, but I do have those scheduled. And if you are, each one of the review sessions will be at 9:30 in the morning, 9:30 to 10:30 on either a Monday or a Wednesday. And so if you're able to join us, if you don't have a conflict in your schedule, I would encourage you to join us for those. They are on Zoom. You should sign up in Starfish, and so you get the Zoom link to use, and then plan to join us that day for some or all of that time. So those are the dates are in the announcement from last week, and they'll show up in our course schedule when we get down far enough as well. So last week we covered chapter 22 on budgeting. Does anyone have any questions, anything you want to talk about from that chapter or anything else? Okay, if there aren't any questions, let's get started with our new chapter for today, which is, as you can see, evaluating variances from standard costs. We have a whole series of learning objectives. Here are the first 4, and then there are a couple more on the next slide as well. So we'll start out this chapter talking about what standard costs are. You've really heard me talk about that already. We just finished the budgeting chapter, so none of this is going to be too terribly surprising for you. We'll talk about what they are and how they're established and how we use those. And excuse me, and then we'll be looking at all the different product costs that we've learned about since chapter 15, direct materials, direct labor, and overhead, how we calculate those variances, the different sources of variance for each one of those product component costs, and what do we do about that? What does that tell us about our business? And as I keep trying to stress, the important part of all of this isn't really how do we do the calculation, but what do we do with it once we know this information? Couple more learning objectives related to calculating variances and reporting on those, because as I just said, the most important part is what do we, now that we know this, what do we do with it? Excuse me, that you'll notice there is an appendix to this chapter, but we will not be covering that in class. It's not in our exercises, it's not on the homework problem, and it won't be on the exam. So you do not have to read that section in the chapter or be able to answer any questions about it. We are not covering that learning objective. So what are cost standards? They are goals. This is what we hope to achieve. So they help us with our budgeting. This is exactly what we think should happen. Now, similar to what we talked about with capacity, that we've got that ideal or theoretical capacity, we can talk about theoretical standard costs or, in a perfect world costs, but we don't think that's actually going to happen. And so for the most part, we want these standard costs to be realistic. This is what we believe we can do, but it is something that's a goal. It's not something we expect to just happen. It's something that we are working toward. And as I said, we'll be looking at the 3 product component costs that make up all products: direct materials, direct labor, and overhead. We'll be separating the overhead into fixed and variable. And for each one of these component costs of a product, we'll be talking about 2 different sources of that variance. So many accounting systems, in particular for manufacturing companies, are set up with the standards built in. And so the concept of standard costing means that we apply those standards, and then at the end of the period, we compare our actual costs to what our accounting records show. We identify those variances. Now, we are going to have to make adjustments so that our financial statements include our actual costs, but it's a very important step for us to recognize, here's what we thought we would be spending, and here were our actual costs, and why are those 2 numbers different? What caused that difference or led to that difference? And that's the idea of managing by exception, that we are looking at how is what really happened or actual costs different than what we expected to have happen. So I already mentioned that concept, just like we talked about with capacity, that ideal or theoretical standard is probably not very useful. It's nice to talk about, but we don't live in a perfect world. And so we want to use realistic standards, standards that are achievable, but not necessarily easily achievable. We want this to be something that we're striving toward, but it's just like we talked, like you may have heard in other contexts, the idea of setting SMART goals. Those goals need to be realistic and attainable if you want people to actually work for them. Otherwise, think about in your own personal life. If you set a goal for yourself that's not realistic or attainable, it doesn't really give you something to strive for, because you just can't do that. That's not going to happen. So we want our standard costs, for that same reason, to be something that is actually attainable. Even if it is difficult, it needs to be possible. And so normal standards are what we should be using within our cost system. These standards should be periodically reviewed. Now, it's up to the company to decide how often those should be reviewed. I would say at a minimum, they should be reviewed on an annual basis, because we do our budgeting on an annual basis, and we want to be looking for, we want to keep that in mind that, hey, these are things that could change. You can see on the screen why some things might change. Product designs, labor rates, manufacturing methods might change. In addition to maybe setting that minimum of these should be reviewed every year, if something dramatic changes, excuse me, thank you. If something changes, if we become aware of a change that wasn't planned or expected, we can go back at any time and review these standards. So, for example, New York State minimum wage will be going up the first of the year. A company, and that was a no, this is planned, but if that's not reflected in a company's standards, if they have employees who make minimum wage or close to minimum wage, they will need to go back and revise those standards, because they're no longer realistic. Minimum wage will be $14.20 per hour in this area of New York. If you have a standard of $13.70 per hour, is that realistic? No, it's not legal. So at that point, our standards should be revised to reflect reality, so that they are still attainable and don't serve as a source of frustration for our employees. And so again, I would recommend that there be a minimum frequency with which these are reviewed, probably annually, but it's appropriate to review them if something unplanned happens. It is appropriate to go back and revisit these standards. Do these still make sense in light of what we now know? Some criticisms of using the concept of standard costs and managing by exception. If we set a goal, and especially if it's not a stretch goal, especially if it's something that's readily attainable, there's really no incentive for going beyond that unless we build that into the system. So I am aware of a company, I don't know how frequently this happens, but one company with which I am familiar sets up their bonus structure based on exceeding the standards. And so they set the standards, here's where we want to be, but we will reward you financially, compensate you for exceeding those standards. So that's one system that might counterbalance this criticism. Standards too difficult to maintain when things change. So our standards go stale and we don't review them often enough. So how do we combat that? We make sure we review them on a regular basis. Make sure that they are still meaningful. As I said, maybe that means every year and more frequently if we become aware of changes. Okay. The third objection. If we're only focusing on improving efficiency, we might lose sight of the big picture. What's really in the best interest of the company? And it may not always be cutting costs. It may be improving product design or something like that, making our product worth more to the customer rather than always focusing just on cutting cost. And the fourth bullet point there, the fourth criticism is we want to make sure that we are making the business as a whole. This is kind of the same idea of that big picture in number 3. We want to make sure that we are keeping in mind the impact on the business as a whole, on our customers, on our employees, of making these kind of goal setting of these standards. And so I think these criticisms are valid and certainly should be kept in consideration, but there are ways around these. There are ways to still use standard costs to give us that performance goal without compromising the integrity of the business. One of our exercises, I think it's exercise number 2, we're going to be doing a budget performance report. And so we're going to see here an example of what that looks like. And so in order to use standard pricing and implement that concept of management by exception, we need to first set the standards. So you can see here an example of what those standards would be. We know we're going to have separate standards for direct materials, direct labor, and overhead, but each of those product component costs, there's 2 possible sources of variance. So let's take direct materials first. When you are making a product, you have a specification for that product made by the engineering or the design team. Here's what's going to go into this product. For each one of those raw materials or direct materials that goes into a product, there are going to be 2 separate standards. How much are we going to use of that raw material, and how much per unit is that raw material expected to cost? So how much of the product are we going to use? Well, that again comes from the design team, the engineering team, in concert with the production staff, with the people who are in charge of manufacturing. And how much are we going to pay for that product? Who tells us that? Same conversation we had last week in the budgeting chapter. Who tells us how much the product should cost to acquire? Supply chain. The purchasing department is going to tell us how much we anticipate spending per unit, per yard, per pound, for whatever unit of measurement that product, that direct material uses. So when we look at, in this example on the screen for XL Jeans, we expected to spend right here $7.50 on direct materials. Now, you'll notice that they're only using one direct material here. Presumably that's the denim for the jeans. It's not necessarily the only direct material. I imagine there's probably a zipper. There are probably some rivets. Thread might be considered an indirect material rather than a direct material, so that would be part of overhead. But as is frequently the case, as we've mentioned in earlier chapters, we are really simplifying this down. And generally for our examples, we'll look at a product that maybe takes one or a couple direct materials. But you can imagine if this was a complex product like the computers that you all are working on right now, there are lots of direct materials that go into a complex product, a typical product. And so you would have a standard for each one of those direct materials. How much are we going to use of that direct material? How much do we expect it to cost per unit? And so the variance analysis that we are doing is a scaled down version, a probably not terribly realistic product where we have just one or a couple direct materials. But as we've said in earlier chapters, if you can do it for one material, you can do it for 20 or 50 or 5,000 materials that go into that product. The reporting that we're doing then, as we've talked about in earlier chapters, the reporting that we are doing in managerial accounting needs to be tailored to the audience. So if you're doing a report to the VP of manufacturing, he probably doesn't need to know how many extra zippers we used, but that VP is probably interested in the big picture. How much did we spend in total on direct materials compared to what the standard said? And then if there's a big discrepancy at the macro level, then we start drilling down into the different components and thinking about what do we do about that? How do we fix this if it's an unfavorable variance? Or if it's a favorable variance, if we saved money, how do we make that happen again? Right? So not all variances are going to be unfavorable. And we have an interest in identifying each variance and then determining to the extent possible, why did that happen? And if it's a favorable variance, how do we make it keep happening? And if it's an unfavorable variance, how do we prevent it from happening again? So again, direct materials, two different sources. How much did we use? How much did it cost us per unit? Direct labor, same thing. How much did we use? How much time did it take? And how much are we paying our workers per unit, per time? Factory overhead, as I said, we are going to be looking at this in more detail. We're going to be separating the fixed from the variable factory overhead, even though right here it's shown as a combined rate. So we will need to dig into that a little bit more to separate out the fixed from the variable, because the reasons for variances in the fixed and variable overhead, the reason for those variances is different. Direct materials, direct labor, and variable overhead are all variable costs. So we're going to be using a flexible budget approach to those. That is, how did our actual spending compared to our planned spending at that level of output? For fixed factory overhead, the flexible budget concept doesn't really apply there, doesn't really help us, because the assumption is those fixed costs would remain the same regardless of our level of production within that relevant operating range. So I don't feel the need to spend a lot of time talking about preparing the master budget. We talked about that both classes last week, but certainly you can review that in the materials in the chapter. I think at this point, we will go ahead and look at our first exercise, exercise 1 for chapter 23. So let's go to that. And exercise 1 is setting the standards. So when we think about the management cycle, this is happening in the planning phase of the management cycle. Before we actually start producing, in this case is unfinished dining room table. Before we start producing that product, we need to set the standard. We need to set those performance goals. Here's how much we expect to spend on making an unfinished dining room table. And so in the budgeting chapter last week, we already talked about the source of this information. So how do we know how much we're spending on direct labor? We talked to the human resources department. On average, our direct labor is paid $28 per hour. How do we know how much time it should take? Well, we talked to the production people. They're the ones responsible, just like in the budgeting process. Those are the people who are responsible for making this happen. So in the sense of participative budgeting, as opposed to that authoritarian style that we talked about last week, if we expect people to meet these goals, they need to have some input, some buy-in, some ownership of where those goals came from in the first place. And so for this unfinished dining room table, for the direct labor, we expect it to take 5 hours per table, and we expect to spend $28 per hour on that labor. So 5 hours at $28 an hour, that contributes $140 to our unfinished dining room table. How about our direct materials? We expect to take 18 board feet to make a table. How do we know that? Well, we looked at the specifications in the design, and we talked to the production people to find out, there's probably some trim that needs to happen. So it doesn't necessarily mean that 18 board feet end up in the finished table. We need to be able to trim or cut out any bad spots or whatever. And so we expect to use 18 board feet. And the purchasing department told us that right now, our expected cost for that oak board, is $12 per board foot. And so that contributes $216 worth of direct materials to each one of our tables. Now we, in chapter 16, talked about the traditional approach to allocating overhead. We're simplifying here to use that traditional approach where we have just one allocation for factory overhead. We have a rate for variable and a rate for fixed. And each one of those is going to be applied based on direct labor hours. How many direct labor hours are we budgeting? Whoops, can't do that. 5 hours of time. And so I'm just going to combine the $2 and $3.80 per direct labor hour. So $5.80 of factory overhead times per direct labor hour times the 5 direct labor hours contributes $29 to the cost of the unfinished table. And so now to find our standard cost for that table, we're going to add together each one of those components. And I got $385 per table. And so as we're producing the table, we're going to look at, sorry, let me step back for a second. As we're producing that table, we're going to be moving the costs through our inventory records, just as we learned in chapter 15. So direct materials into work in process, into finished goods. And if we're using the standard costing approach, this is the cost we are applying for each one of the tables that we finish, $385 per table. But then at the end of the period, we have to reconcile that. We don't get to report on our financial statements what we wanted to have happen, what we thought was going to happen. We have to report actual costs. And so if we're using a standard costing system, that happens at the end of the period. We compare, we analyze, here's what our records show, $385 per table. Here's what actually happened, and we're going to need to do an adjustment for those differences. At that point, we can decide from a management performance standpoint, we can decide, is what actually happened close enough to the $385 that we're going to call it good? Or is there enough of a difference, of variance there, that we need to dig into this further to find out what did happen? So as long as our financial reports, financial accounting statements show our actual costs, there's no specific requirement that we do anything else with the variance analysis. If we use standard costing, we have to at least do the variance analysis. We have to identify them because we need to get our actual costs onto our records. What we do after that is an internal management decision. Is there something here that if we spend time analyzing these variances, it can lead to us improving our performance? And so there's a little bit of a cost benefit analysis going on there. Is it close enough that we're going to call it good, whether it's unfavorable or favorable variance? Is it close enough? Or is there something we can learn from this? Is it worth putting workers' time and effort and energy into tracking down these variances because they're big enough that they matter? So there is no magic number. There is no requirement that you must investigate variances if they exceed X%. Each company is going to decide what their tolerance is. How close are we? Are we close enough? Or do we need to spend time looking into this? What we are going to be doing in the next few exercises is looking into that. So what do we do when we decide, yeah, there's a big enough variance here that we need to investigate and we need to do something about it? Let's answer these last couple questions here and then we can move on. A standard cost system provides Atlas Furniture Company's management a cost control tool using the principle of, we said, management by exception. That we use the standards, that's what we move through our accounting records, and at the end of the period, we check for variances. We see how close did we get. Using this principle, major cost deviations from standards can be investigated and corrected. Again, there's no requirement from an accounting standpoint, there's no requirement that we investigate the variances. And so the company is going to decide, is this a big enough exception that it warrants spending more time tracking it down? Any questions on the upfront part, setting the standards? So it is based on budgets, just like we talked about last week. It's going to be based on, this is what we want to have happen. It should be a bit of a stretch. It should require some work. It shouldn't just be an automatic, of course, we're going to meet the standards, but it also needs to be reasonable, attainable. Okay. Any questions? We will move on then. And so up front, before we start making the product, we have already crafted these standards. And then as we are making the product, we are applying those standards. We are using those standards to reflect in our accounting records the movement of direct materials, direct labor, and overhead through our inventory accounts. And then at the end of the period, we have to compare and make adjustments so that our financial reports show our actual costs. And so that's what we're going to be doing in this exercise, budget performance report. We have our standards for direct labor, direct materials, and overhead. We have our actual costs, and then we're asked to do a manufacturing cost budget, and then do a variance analysis, comparing what we thought was going to happen to what actually happened. Now remember, the difference between a static or fixed budget and a flexible budget. You'll notice it says here at the beginning of March, Salisbury's management planned to produce 500,000 bottles. And the actual number of bottles produced was 525,000. In letter A, we're asked to prepare the March manufacturing standard cost budget when we planned to make 500,000 bottles. This is what we would have expected to spend had we made 500,000 bottles. So 500,000 bottles, direct labor is expected to cost us $1.20 per bottle. 500,000 times $1.20. We would have included in the manufacturing cost budget prepared before we actually start production. This is a static budget based on the anticipated 500,000 bottle production. Direct materials, we expected to spend $650 per bottle times 500,000 bottles of planned production, or $3,250,000. And the factory overhead in this example, we're given just one rate. So this would be the combination of fixed and variable factory overhead at $1.80 per bottle. And then we can add the three of those together. And so before we began production in March, we would have expected to spend $4,750,000 on manufacturing costs for the 500,000 bottles. Oh, whoops. I just noticed something here. So I need to go back up. I'm guilty of not reading every word again. Shouldn't do that. These standard costs are not per bottle, it's per 100 bottles. So I need to divide each one of those by 100. Everyone see what I just did? So it's per 100 bottles. So that's 5,000 lots of bottles as opposed to 500,000 bottles that I should have been calculating there. Any questions though about that? Everybody's okay with just move the decimal place 2 places to the left on each one of those numbers. And then we're asked in letter B to prepare a budget performance report for manufacturing costs, showing the total cost variances for each one of the 3 product component costs. We are asked, this is important, as you know, the software will tell us when it's necessary to use a negative. And it asks us to enter a favorable variance as a negative number. What that means is we spent less than we had expected according to the standard. That would be a favorable variance. We saved money and we're showing that as a negative. So our actual costs are given. We're just going to pull those dollar amounts from right here. The actual costs for the month ended March 31st. And so our actual costs were $49,450. To review from last week, when we talked about a static budget, a budget that does not change. If we compared that total manufacturing cost of $49,450 to our expected cost of $47,500, what would we be saying? Hey, wait a minute. You spent too much. You spent almost $2,000 more than you should have on this production. But what do we know? They actually produced 525,000 bottles. They had expected to produce only 500,000. So from what we know, the fixed costs should have remained the same, but the variable costs, of course, they would go up. Of course, we would expect them to go up because we produced 5% more than we had expected. We would expect then, had we known they were going to produce 525,000 bottles, we would have expected our costs to be 5% higher than that. So what are we going to do with this? Well, we need to take the 525,000 bottles we actually produced and recalculate our budget based on these standard costs. So 525,000 bottles is 5,250 lots or units of bottles. So we're going to take for each one of these costs, direct labor, direct materials, and overhead, we're going to multiply that by 5,250 to determine if we had known how many bottles we would produce, what would our budget have been? $1.20 times 5,250, whoops, is $6,300. Our actual cost exceeded that. That's an unfavorable variance. We spent more on direct labor than we would have expected, even if we had known that we were making 525,000 bottles. So based on the directions we are given, this is an unfavorable variance and we want to show it as a positive number. So you take actual cost and subtract standard cost. Actual cost minus standard cost. If the actual cost is higher, we end up with a positive number for the unfavorable variance. Make sense? Everybody's good? Going to do the same thing for direct labor and for overhead. The 5,250 lots at $6.50 for direct materials. And $1.80 for overhead. Then for each one of these lines, actual costs minus standard costs at actual volume. When we have our negatives and positives correctly positioned here, we can then just net the column together. And you can see that had we known that we were going to produce 525,000 bottles, our flexible budget would have been total manufacturing cost of 49,875, which is higher than our actual cost. So that results in a favorable cost variance. We saved money. The company's actual costs were 425 less than budgeted when we use the flexible budget. Favorable direct materials and factory overhead more than offset a small unfavorable direct labor cost variance. And so this is a nice summary. One comment I would include here is the way we have done this with the factory overhead disregards or assumes that all factory overhead is variable. And so ideally, that factory overhead should be separated between the fixed and the variable cost. Because what we have just done is increased all of the variable and the fixed factory overhead in that standard cost column. Other than that, this is a nice summary, a nice way for us to see the importance of using the flexible budget, of rewarding appropriate behavior. And now what? What do we do with this? Well, the first thing we need to do is adjust our records to reflect our actual costs. If we're using standard costing, our books would now show that we had $49,875 in cost, but we didn't. We had only $49,450. So this $425 would need to be adjusted so that our actual costs are reflected on our financial statements. Then what do we do? So that's the required part. That has to happen. We have to show actual costs on our reports, on our financial statements. They cannot be estimates. They cannot be standards that were, this is what we'd like to have happen. It needs to be actual costs on our financial statements. But what happens next, as I have said, is totally up to the company. They may look at this and say 425 out of 49,875. Whoops. Yeah, 49,875. That's less than 1%. Less than 1%. They might say, that's close enough, really. We're happy with a variance of 0.8%. We don't need to dive into why is this off by 250 or that off by 325, because it's only off by 0.8%. And they may not do anything else with this. They may say, we're good. Keep doing what you're doing. We're good. But they might say, yeah, but I'm really concerned about that unfavorable variance in direct labor, 250 out of 6,300. That's not less than 1%. That's almost 4% variance. And it's unfavorable. We need to do something about that direct labor, almost 4% unfavorable variance. So let's look at that one. Or they may look at each one of these categories and say, we want to look into each one of these further. They might have a requirement that unless you're within 0.5%, we're going to investigate. I don't know. It's up to the company. I can't sit here in class and say they should do this or they ought to do that. It's really up to the company. Is this enough of a variance that we need to investigate, that we need to tease apart? Where did the direct labor variance come from? Where did the direct materials, where did the overhead variance come from? There's not a wrong answer to that, other than to say that if it is a material difference, if it's something that reflects a real problem, an ongoing problem in our production process, we should be investigating. And if we just think it's a routine, random variance, and some months it's a little bit higher and some months a little bit lower, we probably don't need to waste anyone's time looking into the 0.8% variance. Does that make sense? So we have to find the variance to make the adjustments in our financial reports, financial statements. There's no requirement that we go beyond that. But it might be good business practice. It might help us to improve the overall performance of our company. Or in the case of favorable variances, it might help us to sustain those, which are obviously a good thing. Okay, any questions at this point? We feeling comfortable with the idea so far? Let me go back to my PowerPoint, but I'm going to skip ahead a little bit. Let's start with this one. So I've really already explained what this diagram is showing you, but just as a reminder, as we lead into our next exercises, for each one of the product component costs, direct materials, direct labor, and overhead, we can break that down further. Where did that variance come from? Did we use too much? Did we pay too much for what we used? And that's really for direct materials and direct labor, even though they call them something different, it's really the same concept. The direct materials price variance and the direct labor rate variance are really the same concept. How much did it cost us? What was the price? So we don't call it a price of labor, but that's really what it is, right? How much are we paying our workers? It's the price of their labor. So you can call it the direct materials price variance, the direct labor rate variance, but it really means the same concept. How much did we pay per unit? And the same analogy is true for direct materials quantity and direct labor time variance. How much of it did we use? And so they're measuring the same concept. How much did we use? How much did it cost per unit for what we used? And so once we've made the determination that, hey, we know the overall variance and we've made the adjustment to our financial reports, then if we decide we need to dig into this further, we need to identify the actual source of that variance. That's what's coming next. And in exercise 3, we're going to be looking at the first one there, direct materials variances, and teasing apart, here's our total variance in direct materials. How much of it is because we use too much and how much, or too little, I shouldn't say too little, too much or not as much as planned. And how much is because we paid more or less per unit, per pound, per foot, however we measure that direct material. How much is because we didn't pay what we thought we would per unit, and how much is because we didn't use the amount we thought we would use. And so that's what we are going to see in our next exercise, is how do we tease apart that direct materials variance. We are going to have a total variance, as we just saw in that last budget performance report. And then we're going to separate that into how much is price, how much is quantity. And so we'll end up, jump ahead here. Yeah, we'll start here. So once we have identified the total variance in our direct materials, then we're going to tease it apart. Here's how much is price, here's how much is quantity. And you can see our first formula there is for direct materials price variance. It's right near the top of this slide. You may want to make a note of that. That's what we're going to be using in our next exercise. As long as we're here, I might as well show you the other formulas as well. Here's the direct materials quantity variance. So how much more or less did we use than we expected? Multiply that by the standard price to get the quantity variance. And then if we net those two together, the price variance and the quantity variance, we get the total direct materials variance. We completely explained why it's different than what we had budgeted or built into the standards. So let's go to exercise 3. Excuse me. As we go through these exercises, I want you to reason through it, make sure it makes sense. I really would prefer not to have you just plug numbers into the formula and then plug them into the exercise here if it doesn't make sense what it is you're actually calculating. So it's nice to have the formulas and be able to use them. But to me, I would really prefer that you understand the why part of it, not just how to calculate the number, but what does it mean? The following data relate to the direct materials cost for the production of 50,000 automobile tires. We expected to use 730,000 pounds, but we actually used only 725,000 pounds. So what do we know already? We used the quantity variance. We used less than we expected. That's a favorable variance. We used less than we expected. The quantity variance is going to be favorable. And I'm actually going to note that right now. We're going to have a favorable quantity variance. We save money by only using 725,000 pounds rather than the 730 that we planned, built into the standard. How about the price though? Our actual price was $3 per pound and the standard would have had us spending $2.95 per pound. So the price variance, is that going to be favorable or unfavorable? Unfavorable. We spent 5 cents more per pound than we had planned. Might there be a relationship between those two things? Might it be that we had to use less of the material because we bought a better quality material? That kind of makes sense. It's one possible explanation, right? We used less of it because maybe there was less scrap because this material just worked better because it was more expensive. It was a better quality product. That could be. That's just one explanation. For us in this classroom, we can't know with just the information we're given here exactly why we used less material than we had planned. But if we work for this company and we're doing this variance analysis, that's the question we're going to ask. When we discover this variance, we're going to go to the production people and say, hey, the standard says you should have used 730,000 pounds. You only used 725. Do you know why? What happened there? And maybe they know, maybe they have some insight into it. We can't know without going out there and asking the question. And to a certain extent, that's the concept of management by walking around. You have to be out there. You have to talk with the people who are responsible for this, the people who know what's going on. Why did you use 5,000 pounds less of the direct material than you expected, than the standard says? Is the standard wrong? Or did something else change? And by the way, good job, because we have a favorable quantity variance. You did a good job saving material. Is this something that's going to continue? Or was it a one-time thing? I can't answer the third question yet about the total direct materials cost variance. We know these two are going to offset each other. They're going to net against each other because one's favorable or one's unfavorable, but I don't know yet which one is bigger. And so I don't know whether yet, I don't know whether the total direct materials cost variance will be favorable or unfavorable. So we'll come back to that. But now let's do the actual calculations here. We'll start with the direct materials price variance to find our actual dollar amount. So we're doing the price variance. Obviously, it's direct materials. And I showed you the formula in the PowerPoint. I showed you this formula already. Actual price minus standard price times actual quantity. And so the actual price was $3. The standard price was $2.95. It cost us 5 cents more per unit than we had planned, and we used 725,000 units. So at 5 cents extra per unit times the 725,000 units, pounds, we actually used, the total dollar amount of the variance is $36,250. And it tells us to enter a favorable variance as a negative number and an unfavorable variance as a positive number. This was an unfavorable variance, so we're entering it as a positive value. Make sense so far? Again, I want you need to be able to use the formulas, but I also want you to be able to think through why it's favorable or unfavorable. Where does that number come from? What does it mean? And if everybody's okay with that, then we'll go ahead to the quantity variance. And again, I showed you this formula in the PowerPoint. So we're doing the actual quantity. I'm just going to abbreviate here. Minus the standard quantity times the standard price. So actual quantity minus standard quantity is minus 5,000 pounds, right? 725 minus 730 gives us a negative 5,000 pounds at the standard price of $2.95 per pound. And so you can see why that ends up as a negative, because the actual was less than the standard. We know it needs to be negative because it tells us to show a favorable variance as a negative number. We know it's favorable because we used less than we had expected. Now there's two ways we can get to the total direct materials variance. We can simply net these two numbers together. 36250 minus 14,750 gives us a positive 21,500. That tells us that the net variance of the total variance is unfavorable. If you're not sure about that, you can check it though by doing the total actual and the total standard cost. So 725 times 3, 725,000 pounds at $3 per pound minus 730,000 pounds at $2.95 should give you the same number. The direct materials price variance should normally be reported to. Okay, so this question gets to the heart of what do we do about this now? Is this a number that's big enough to matter? We know we have to do the overall calculation for the direct materials cost variance because we need to adjust that in our records. We know that part has to happen. But from an internal management standpoint, the next question is, okay, we know what the variance was. Now what do we do about it? That reporting piece is so critical because we as accountants, remember, okay, I know none of you had me for financial accounting, but in financial accounting, one of the very first things that I talk about, chapter 1, is why do we do any of this stuff? Why do we do accounting? And the whole reason, the whole purpose behind what you've been learning for the last 23 or so chapters is helping decision makers make decisions. In managerial accounting, those decisions are being made by people inside the company. It does us absolutely no good as accountants if we sit in our cubby holes and do all these calculations and have them all perfect if we don't do anything with it. So part B gets to, what do we do with this? Now that we know where the variance is coming from, what do we do about it? Who do we tell? Where does the report go? The price variance should be reported to the purchasing department. Remember, when we set up these standards at the beginning, we said, who tells us how much this product is going to cost? The purchasing department. They are the source of the $2.95 per pound. And now it turns out we actually paid $3 per pound. That needs to be brought to their attention. If they know, fine. And maybe they're going to say, yeah, there was a shortage of that material, and so we had to get the little, slightly more expensive material, and that's why we had to use less of it, because it was a better quality of material. That's one possibility. When lower amounts of direct materials are used because of production efficiencies, who should be told that? The production supervisor. When the favorable use of raw materials is caused by the purchase of higher quality raw materials, the variance should be reported to the purchasing department. And so that's the scenario that I already speculated could be what happened here. We use less of it because we bought better quality stuff. That last sentence is conjecture, just pure speculation. But if we worked for this company, that's the kind of question we'd be asking. We'd be talking to the purchasing department about, you told us it was going to be $2.95 a pound, but we actually spent $3 a pound. What happened there? Is this something that's going to continue? Green check marks in there. Okay, any question? So at this point, you should be comfortable with knowing how the price standards are set and calculating direct materials variances. Questions on that so far? Let's move ahead then to our next exercise. And our next exercise is also calculating direct materials variances. And so what I would like to ask you to do is to try this on your own. I'm going to pause the recording and ask you to try this on your own. Once you have your answers, certainly you can use the check my work button. If you don't have them correct, try again. Once you've done the best you can, whether you have all the answers or not, go ahead and restart the recording, and I will have some calculations written on my screen, and I will quickly go through where the calculations come from so that if you aren't able to find the final answers, you'll be able to watch the rest of this part of the video to see where they come from. So I'm going to pause the recording at this point. Please restart when you've done the best you can with this exercise. Okay, so how did we do with the direct materials quantity variance is the only part that we were doing here. So for the first part, part A, we are asked to determine the standard unit cost per pound for a standard batch. So I have the calculations up here. Get them a little bit better, maybe not. There we go. So the standard cost, pounds times dollars given in that first table. So there's all of the calculations, $4,590 for the batch. And we are told up here at the very beginning that the batch is 7,650 pounds. So I took that total dollars divided by the total pounds to get 60 cents per pound is what it should have cost according to our standards. Then to calculate the quantity standard in part B, actual minus standard or planned usage. So for example, for tomatoes, we used 100 pounds fewer than we had anticipated. So at 75 cents per pound, that saved us $75 on tomatoes. That's a $75 favorable variance. We need to show it as a negative to indicate that it is a favorable variance. You can see we went back and forth. We used more vinegar and salt than planned, but less tomatoes and corn syrup. And so when we net all of those together, we end up with a net favorable, a net negative variance of 55.50. So any questions about that exercise? You should be comfortable identifying where there are favorable and unfavorable variances, both price and quantity for direct materials at this time. Okay. And if there aren't any questions, let me get my annotations off the screen, and I'm just, whoops, somehow clear those. And then I'm going to go back to the PowerPoint just for a moment so we can talk about direct labor. I'll start there. And in our next exercise, we're going to look at direct labor variances. This will be the last exercise we do together today. And when we finish this exercise, I'm going to talk for just a minute about what I would like you to do before our next class on Thursday. So for our direct labor, I already reminded you as we started this whole conversation that there are also going to be two sources of variance for direct labor. How much did we use? That is, how many hours did it take to make the product? And how much are we paying per hour? So those really are the same concept as what we just did with direct materials. It's quantity and price. And how much did we use? How much did it cost per unit of use? And when we're talking about labor, we're measuring usage in time. How long did it take? And how much are we paying our workers per hour? Just like with direct materials, there'll be a total direct labor variance, and then we can isolate the parts that are because it took too long. So that's an efficiency variance. How long did it take? But there's also the rate variance that maybe we didn't pay our workers on average what we expected to pay. So we've already talked about where the sources of those standards would come from, and the same concepts apply as what we discussed with direct materials. Once we identify these variances, who do we notify? If it's efficiency, how much time it's taking, who do we want to talk to? The production supervisor. Hey, the standard says it should have taken 5 minutes and it took you 6.5 minutes. What's up with that? Is the standard wrong? Do we have brand new workers that are taking longer because they're being trained, they're just learning? And then as far as the rate goes, if we identify variances within the rate, we're going to talk to human resources. But again, it could be they could be working together. So maybe it took us longer, but we paid less per hour because it is those trainees, those brand new employees that are still learning. And then we have to really look at it. Did it save us money to have cheaper labor working if it took them longer? Did that more than compensate? And so we're going to be looking at those calculations as well. And so just like for direct materials, we have two formulas. You can see here at the top of this screen, the first formula, the rate variance. Actual rate minus standard rate times actual hours. And then for the time variance, or the efficiency variance, actual hours minus standard hours times the standard rate per hour. So those are the two formulas that we're going to be using. And the total direct labor cost variance will be the combination of those two things together. If they're both positive, they're going to be added. If they're both negative, we're going to add them. If they're one very favorable, one unfavorable, we're going to net them together. And so let's go to exercise 5. The following data relate to labor cost for production of 20,000 cellular telephones. We have our actual hours and our standard hours, our actual quantity, the price, the rate that we're paying our workers on average, and the standard. So just like we did in exercise 3, I want to talk about whether these are favorable or unfavorable. The rate variance. We expected to pay 23, we only paid 22.50. Is that going to be a favorable or unfavorable variance? Favorable, we paid less than we expected. How about the time variance? We expected it to take 8,400, but it took longer than that. So that part would be unfavorable. And we don't know until we get the combination of those two, whether the total variance will be favorable or unfavorable. But what we're seeing here is exactly the scenario that I already proposed could happen. We paid less, could be less experienced workers, new hires that are still in training. And that would also explain why it took them longer, because they're just learning the job. Both of those things are possible. I don't know that that's the answer, but it could have been contributing. So let's do the rate variance. I'm going to put the formula on the screen. I just showed you the formula in the PowerPoint, but we'll do the rate variance first. Direct labor, rate variance. And the formula is actual rate minus, myself a little more room there. Oops. The actual rate minus the standard rate per hour times the actual hours. And so what did we see? Actual was 22.50. The standard was 23. That's a negative, whoops, negative 50 cents per hour for the 8,450 hours that we worked. We saved 50 cents an hour for the 8,450 hours we worked. The rate variance then is $4,225. That's a favorable variance, so we're going to show it as a negative. I really should have, whoops, I should have put a negative. I had a negative in my formula. I should have put a negative there. Whoops. Yeah. Had the negative here in front of the 50 cents. I just forgot to include it there. Knew it was needed. And then we can do the time variance. Whoops. And so again, the formula that I had shown you in the PowerPoint for the time variance, actual hours minus standard hours times, makes up a little more room, times the standard rate per hour. We actually worked 8,450 hours. The standard was 8,400. So we have an overage of 50 hours at the standard rate of $23 per hour. That's $1,150 for the time variance. We already knew that would be an unfavorable variance. It took us longer than we had anticipated. But when we net these two things together, 42.25 and 11.50, we end up with a net negative or favorable variance. The fact that we paid our workers 50 cents an hour less than the standard saved us more money than it cost us because it took them 50 hours more than we planned. Everybody okay with those two calculations? And just as I told you with the direct materials, we could have also come to this total direct labor cost variance number independently by, because we have time, I can show you this. By doing the extensions here, 8,450 hours at $22.50. We actually spent a total of $190,125 on direct labor. The standard for the 20,000 telephones, 8,400 hours at $23, we expected to spend $193,200 according to the standards. And so the total direct labor cost variance down here is the difference between our actual total spending and our planned or standard total spending, $3,075. As I explained this, that number, then the negative $3,075 or the favorable total direct labor cost variance, that's the number we actually are required to calculate, because we need to match our actual spending on the financial statements. The other part, teasing it apart into the rate variance and the time variance, that is for internal purposes only. That's to help us make sure we're managing this company efficiently, that we know why we didn't meet our standards if we didn't meet them. And let's look at our answers then to part B and finish up this exercise. The employees may have been less experienced or poorly trained, thereby resulting in a lower labor rate than planned. The lower level of experience or training may have resulted in a less efficient performance. Thus, the actual time required was more than the standard. If that's really the explanation here, what are you telling management? Is this a good thing? We saved money, right? By possibly having more, less experienced employees working. I don't know that we want to encourage that. Maybe we need to figure out how to improve efficiencies so that our older employees we're getting what we're paying for. I don't want to say it like that, but I'm not sure how else to say it. If this was the only information we had to go on, would we say that it's a good thing to have the less experienced workers working? Yes, because we did save money, $3,000. I hope that there's more to it than that. Because if not, what that implies is that we're giving pay raises to our more experienced workers, but they're not earning those raises because they're actually less productive per dollar. They're producing more per hour, but not enough more to compensate the extra cost. And I don't think that's ideal. I don't think that's what we necessarily want to be saying here. But based strictly on these numbers, that's what I would say. Okay. Any questions about calculating direct labor or direct materials variances? Or what we do with that? How do we use this to help improve efficiency? Okay. So I said that's the last exercise we're going to do together today. But as you look ahead to exercise 6, you can see that this is a direct materials and direct labor variances problem. So we already know how to do both of those. I'm going to ask you either in the 10 minutes we have left in regular class time or sometime between now and Thursday's class, try this one on your own. Excuse me. Try this one on your own. If you do have questions, I would be happy to answer them at the beginning of class on Thursday. You could send me an email. If you're here in class and you're sticking around and working on it, I'll be happy to answer those questions while you're still here in our regular class time. I'm going to go ahead and stop the recording at this point. And for those of you who are watching on the recording, I will very briefly, quickly go through this and any questions at the beginning of class on Thursday.